afternoon, everyone. I'm Pamela Hastings, Relationship Manager at Barometer Capital, and we welcome you again to another Barometer webcast. Joining me today, as always, is David Burrows, our Chief Investment Strategist and President at Barometer Capital. On today's episode, we will provide you with a brief macro update, and of course, we'd be pleased to address your questions at the tail end of the conversation. So don't be shy, hit me up on the chat at phastings@barometercapital.ca, or as I just mentioned, hit me up on the chat via Zoom. And with that, on this very cool afternoon in Toronto, I turn the conversation over to David Burrows, where his fire is burning and he is excited to walk us through recent volatility in the market. Over to you, David.
Thanks, Pam. Hey, folks, thanks for tuning in today. Yeah, it's been a bit of a bumpy week, and it's one of those weeks when you're happy to have a process and a set of rules for making decisions. I think I'm going to try and kind of walk through what we're thinking and what we've been seeing over the last week, 2 weeks, really, since U.S. Thanksgiving and going into U.S. Thanksgiving, what a difference a week makes. So let's just start from the top. As we've been talking about, we believe we're in a structural bull market in stocks. This is the U.S. stock market going back to 1900. And there have been a number of structural bull markets along the way in dark blue that lasted, in general, sort of 15, 18 years. This one started in 2013 when we exceeded the highs from the year 2000 and the end of the tech boom. And there's certainly been some pullbacks along the way, but a structural bull market is a market with a tailwind. It generally starts at a time when the asset class is hated and unloved. And I've had lots of conversations early in structural bull markets where people said, look, I have no interest in stocks. They haven't done anything for years. And then, of course, at some point, the general public likes to get involved. And I think that we're in a different world today. The retail and public investor is very engaged. And markets have been marching kind of along. U.S. market led off the bottom, and we've had other global markets join along the way. And certainly equities have been a place that we've been focused in because we've been seeing structural revaluation as time has been going by. We also have had a view that we were going through a structural bottoming in interest rates after a very long disinflationary period that started with the mid-teens interest rates of the early 1980s. And through that period, there are certain sectors that really benefited from falling rates. And certainly we've seen an uptick in debt taking on along the way as the cost of money got cheaper and cheaper. And we went through sort of some watershed low yields in 2016 and again in 2020 at the pandemic bottom around 50 basis points. Much like we saw in the late 1940s, early 1950s, a shift taking place. And you always have to recognize these shifts because what works in rising rates is not necessarily what works during falling rates, but what worked during falling rates for 30 years made people feel very confident. So that's something, an ongoing discussion that we continue to talk about. We'll talk about again today. We also think that we've been going through a structural bottoming in returns for commodities. And commodities definitely went through a bear market from 2008 through 2020. 13 years is a long time for people to build a view. And so it's a hard one for people to get their heads around owning rocks and trees and things that go into building materials. But certainly from the bottom, at the COVID bottom, the 10-year annual returns have moved from almost minus 10% a year to just slightly positive. And generally, once that begins, it goes on for a great number of years. And this is a sector of the market that's generally underowned and unloved, which is a good thing if you get there early. So from an asset class perspective, equities have been a big favorite of ours, bonds not so much, commodities more so, and reflationary assets in general, which we believe we're in the very early stage of a reflationary cycle. Now, last Tuesday, we did this call. This was the market map for the day. It was not a particularly pretty day. If you can remember, on Friday after Thanksgiving in the US, there was the news of the Omicron virus strain that kind of started to hit the markets. There was very little information at the time, still very little information, probably more now today than there was then. And lots of concern that this was going to put the world back into a tailspin, and in a thin market, lots of selling. The selling continued on Monday and Tuesday, and we came into the call last week to make an assessment as to whether this was something that was a serious threat to markets and what we could read, what was happening underneath the surface on a sector basis, because clearly on a day like last Tuesday, almost everything was being sold. Well, here we are today. A slightly different view. This is a market map by sector for the NYSE. And you can see from a sector perspective today, the strong groups have been financials, industrials, technology, consumer discretionary, energy, and materials. So those are pretty common themes to the groups that we've been focused on over the last period of time. And we discussed some of these groups in detail last week. We'll talk about them again today, 1 week fast forward to see where things have gone. We talked about the fact that we were into a seasonally stronger period of time. November through April tends to be the strongest period of the year. However, we have talked about the fact that November can often be sloppy into the beginning of December, and certainly we've had some of that. So last week on Tuesday, we talked about the fact that the average company in the S&P 500 during this little pullback had pulled back about 13%. Now that certainly wasn't represented in the index because big stocks like Apple and Microsoft were hanging in particularly well, but under the surface, there was some pullback taking place. We noted that the median pullback for just a short-term correction was about 13%. We were sort of there. We pulled back maybe another 1.5 or 2% during the week last week. But let's take a look at the action. So this is the S&P 500. This is the pullback that took place over the last couple of weeks. Sort of at the worst point, it was down about 5.5%, obviously positively impacted by the largest cap tech stocks. We pulled right back into the 50-day moving average. So last Tuesday, we were just hovering above the 50-day. We made a low on Wednesday, we rallied. We made a lower low on Friday and then rallied Monday, Tuesday. So internally, when we look at that, there's some things for us to take away. Certainly when we looked at the equally weighted S&P 500, it pulled back a little bit more, about 7%. But interesting, when the market made its low on Friday, the equally weighted S&P 500 did not come back close to making a new low. So what does that tell us? It tells us that often later in a short-term correction, the strongest stocks get hit, the biggest heavyweights. But by the time that was happening, perhaps it is that the average stock had already made its low on the previous Wednesday. Now, this obviously will have to play out. But what I would say is we made a low on Wednesday, a higher low on Friday. We made a higher high on Monday. And today, of course, a much higher high. Nice follow-through day. Follow-through day is a day where you move 2% on good volume with a high percentage stocks in uptrends, moving their way higher in the day. And we certainly got that. So the average stock started telling us something in the middle of last week after pullback to the 150-day moving average. If we look at the Nasdaq, you can see it. This was the day on Friday. So Nasdaq had a particularly bad day on Friday, but again, just down to the 50-day. We bounced a little on Monday and certainly had a good day today. Looking at it in another way, this is the Russell 2000. And we talked recently about the fact that the Russell 2000 has been consolidating really since February of last year. So there's a broad-based index, 2000 stocks, small to mid-cap securities, more heavily impacted by the US economy. It pulled right back into support, pulled back 11.5%, a lot like the average stock in the S&P 500. This was last week, and here's where we are today. Made a higher high on Wednesday and then a higher high on Friday, higher low on Friday. And then today rallying back above the long-term moving averages. So somewhat encouraging because we did find support at all of these recent support levels and rallied off it. So we'll see where we go from here. But I would say that a number of these indices got to oversold territory from a short-term perspective. And then underlying the whole broad-based indices, sectors acted like sectors. They didn't all behave the same. So what we really care about is what's happening underneath the surface. Is there leadership and are there laggards? Or is it a macro issue where everything's being impacted the same? We prefer a market that's acting like a sorting hat, sorting the good from the bad. And if the market's doing that, generally it means the market is continuing to behave constructively. From a volatility perspective, we made a closing high on Wednesday. We made a lower closing high on Friday when the S&P undercut. And of course, vol has dropped precipitously over the last 2 days, perhaps signaling that we may have run the course in this short-term correction. Longer term, the S&P remains in a structural bull market. And if we were to compare to the bull market of the 80s and 90s, certainly less than half from a duration standpoint at this point, and a fraction of the return that we saw in the 80s and 90s. So this would suggest likely we have some room to run, and it wouldn't be unreasonable to think that as we look beyond this most recent COVID variant, and as we look beyond some of the challenges that we've been seeing, markets may be sniffing out the fact that we are going to move into the next leg of this economic cycle. Okay, so last week, we highlighted that our short-term indicators had been negative. We talked about that over the last few weeks. We talked about the fact that the longer-term NYSE indicator had reversed down, so we were more cautious. We talked about the fact that we would be very tough with our stop losses if required, and that we wouldn't be putting on a lot of new positions unless the sector work was really constructive. So here's where we are this week, and this was as of yesterday. So percent of stocks above the 50-day moving average had turned back higher. Percent of stocks trading above their 150-day moving average also had turned back higher. As of today, the percent of stocks with positive weekly price momentum has reversed back higher, making 3 of our 4 short-term indicators positive. And NYSE bullish percent is within 1% of reversing back to green. So that isn't conclusive, but certainly supportive of the fact that we may have put in a near-term bottom. So we have to go underneath the surface and look at sort of the sectoral themes. So let's talk a little bit about that. Our job isn't to be everywhere. Our job, as you know, is to focus in areas of market leadership and to question every day, does the leadership remain constant? Is there new leadership emerging that we should be looking at? And if things are really sloppy, are there things that need to be sold? Because we're very happy to sit with cash in the portfolio. We don't have to sit through a lot of volatility. If our work is not constructive, we'd rather sit in cash. So it is a very tactical approach. Market clearly was worried about Omicron, and obviously also worried about Powell's comments on inflation being less transitory and somewhat more persistent. Now, as you know, we've talked about being positioned for a reflationary environment, and that the things that work in that environment are quite different. So certain sectors more handicapped if rates start to rise, certain sectors more helped. So from a bond perspective, our view has been that yields are going higher. This is the 2-year US government yield to today, making a new high. So market clearly has a view that short-term rates are headed higher, which means short-term bond prices are falling. Here's the 5-year yield. Same thing, a series of higher lows and higher highs. So 5-year yields moving higher as well. Outside of the US, this is the Canadian short-term bond index, made a new low today. So as yields are going higher, it means prices for bonds are going lower. If you're getting a very small coupon and the bond prices are falling, you're not making any money. And so this has been a group that we've been very cautious of, bonds and anything that acts like bonds. So this continues to be the case. Now, I would just make the point that if people were concerned that the Omicron variant was going to cause an economic slowdown, bond yields wouldn't be moving higher, they'd be moving lower. and bond prices would be moving higher, not lower, which is not the case. So this is Canadian bonds. This is global treasury bonds. You can see falling quite precipitously through into the spring of this year, consolidating over the course of summer, and then heading lower again. No sign here of a cause for concern that the economy might be rolling over. So what does that mean for sectors? So this is the XLF, the financial sector ETF, as we saw it last Tuesday. And we highlighted that, yes, we had pulled back to the longer term moving average. When we looked at the point and figure price chart last week, we highlighted what we're looking for is higher lows and higher highs. And we were making higher lows and higher highs. This hadn't broken down. Pullbacks are natural. The question is, do they pull back enough to break trend? And as of last Tuesday, that was not the case. As we sit today, yes, it did pull back last week into support, but on Wednesday made a higher low, Friday made a higher low, and here we are today, back in and around the 50-day moving average, continues to be constructive. Within that group, we talked about broker dealers and capital markets banks as being continue to be constructive after consolidating higher low, higher high, higher high, higher low. This week, same thing. After touching on the long-term moving average, slowly started to work its way back higher over the last few days, back above the 50-day moving average. Technology. Obviously, technology has been a leadership group in the market. The XLK ETF is dominated by larger cap, cash flow generating technology companies like Microsoft, Apple, Google, and so on. Was hanging in very well last week and continued to hang on well through the week. There's the XLK today, making a new high. One of the most important things you can look at when you go through a correction is what is it that pops back quickly, hangs in better than the market through a decline and bounces back more quickly coming out of a decline. It really took about 1 day for us to find our way back up into the higher end of the range in the XLK. And look at Apple making a new all-time high today. Semiconductors, we noted that we had a fairly typical little pullback, as we've seen many times before. Today, on the first real day of strength for tech, the semiconductor ETF XSD makes a new all-time high. So certainly no break in leadership here. NVIDIA is a great example. Had a choppy week last week, but trading very close to highs. Let's talk about energy. Last week, the XEG had pulled back to the 50-day moving average. We talked about the fact that the point and figure chart continued to be constructive. It pulled right back into support. And here we are today, back toward highs. So this is all very encouraging. And it's not to say that we're completely out of the wood with this new variant. It's not to say that the market won't continue to be concerned about Fed Chair Powell raising rates earlier than what had been expected. But so far, the market is telling us that these leadership groups continue to be leadership. They've held long-term moving averages and moving higher. CNQ, one of our biggest holding, Canadian Natural Resources, again, trading back at new highs today after consolidating over the last few weeks. Let's move to industrials. This is an ETF of equally weighted industrials companies. Last week, it certainly pulled back off the highs, continued to be constructive on the point and figure chart. And as we sit today, really, that was the low last week. Market has slowly chopped higher, actually against a falling index. So back toward highs. Materials, after pulling back to the 150-day moving average, again, over the last 4 days, slowly starting to move back higher. So very encouraging that the leadership groups, the groups that are more economically sensitive, the groups that are more reflationary, the groups that do well if we need to have companies that have an ability to raise price to offset inflation. All of these companies and all of these sectors have that same characteristic. Here's Tech B, one of the great holdings you could have as a basic materials companies to kind of cover the waterfront, minerals and energy. After consolidating for several weeks, popped back above trend line today. This is the ETF for the forest products sector. Now you can go back to 2018. This group went through a difficult period going through into COVID, rallied and made a new high, consolidated, and this week popping back above trend line and turning higher. One of the companies that we own is Interfor. You can see against its sloppy 2 weeks, very consistently worked its way higher, making a new high going back all the way to the spring of this year. And this is an important group because, again, economically sensitive. It fits into that construction, home building, home improvement theme. There's the copper sector, looks very similar, 2014 through present, certainly consolidated through the summer, and again today popping back up through trend. Consumer discretionary group, as of last week, hadn't seen any reversal on the point and figure chart and did pull back a little bit later in the week, pulled back into the 50-day moving average, pulled back a total of about 7.5%, turned higher quickly and working its way higher. It's certainly not a group where everything's working, but we talked last week about home builders being particularly strong. They made a new all-time high today, and this is the home construction materials sector, ITB, making a new high. This would include companies like Home Depot, which continues to march along. Relative strength versus market continue to improve. So these groups continue to act well. Now, there are some groups that are kind of broken, and these are things we don't want to own. We don't want to own all of the S&P 500. You can go buy the Spider ETF and get that for free. Our job is to pick our spots. This is the Jets ETF, made up of the airlines, and certainly had a little bit of a bounce over the last 4 days, but is still technically broken, trading below its long-term 150-day, 200-day, 50-day moving average. Also, its 21-day moving average in the just above the 7-day moving average. But this is going to have to do some work. So travel and leisure continues to be an issue, which would make sense given where we are on COVID. On dividend achievers or dividend growers, we highlighted that last week it had only just pulled back a little off of the highs, and point and figure chart continued to be constructive. When we look at it today, yes, that pullback was short-term in nature and very quickly moved back towards highs. So dividend growth continues to be an important theme. Let's contrast that to high dividend payers. This is a dividend of ETF of global high dividend paying stocks. And certainly it's bounced a little over the last 4 days, but this is not something we would be interested in. It started to lag early. It's underperformed the market. It's below all of the long-term moving averages. Again, that tells me high dividend paying stocks a lot less attractive than dividend growth stocks. Dividend growth stocks being our core theme for income this year. In the absence of fixed income and high dividend paying stocks doing well, dividend growth more attractive if we are in rising rates. So to put a point on that, here's the IYZ, the telecom ETF. Again, not a high growth sector, pretty stable, high dividend payers, but really total return is the name of the game. Share price plus income. If your share price is dropping, doesn't matter what the income is, not going to do you much good. The other group that was weak last week going in was the high multiple, unprofitable innovation technology. So this is Cathie Wood's flagship ETF, ARKK. Now, as of last Tuesday, was at $104. We talked about the fact that this is something we are short in our macro portfolio. This is a theme that's been very popular with individual investors, some of the very high multiple stocks, one that in my opinion has been quite broken. When we fast forward a week, what was 104 last week got as low as 90 yesterday, traded up a little bit today, but still trading well below last week's price. And while it had a good day today, to me, this is a technically broken stock. Nothing changed. Same on biotech, technically broken, little bounce today. We'll see whether that can turn into something. This would not be an area that we'd be focused in. There's the XBI point and figure chart from last week with the breakdown at 114 as of last Tuesday, traded down to 108 as of yesterday, back at about the same level. But again, this would be something I would be a seller of as opposed to a buyer. No support from a trend perspective there. So it continues to be a market that's sorting good from bad. There certainly are sectors that are having difficulty. There's certainly sectors that are leading. If you pick your spots, I think you put risk reward in your favor. And we're always looking for new areas of strength. And one of the groups that has been standing out over the past week have been some of the REITs. And again, it's not all of them, it's a couple of specific areas. This is the REZ REIT that's invested in residential and multifamily real estate. Make a new high, very shallow pullback on the weakness and right back to highs. So this is a relatively new holding for us. And the industrial REITs, this is the REZ, looking at it another way. And then the industrial REITs like Granite REIT, which has been a major holding for us, held in like a champ. So this is an area that we actually increased some exposure in this week. Again, always looking for strength, because strength and weakness beget strength in a better market. And you can see right back to make a new high. So in the end of the day, I think the major driver here is there are lots of companies with very significant free cash flow margin and free cash flow yields relative to history. And when we go back to where the market peaked out in the year 2000, companies, the average company in the S&P was trading with a 1.6% free cash flow yield. Today, ex technology, the free cash flow yield for the S&P is almost 5%. So we compare that to the yield on a bond at 1.4% in a 10-year. That's pretty attractive. We're getting compensated well for risk. So we think that the free cash flow generating companies and those with an ability to raise price, as demonstrated by the fact that these groups held up well over the last 2 weeks in a sloppy market, are the areas that are going to continue to attract capital. So let's put this all in a bow. Financials, as of last week, about 31% of the portfolio, we added to our financials over the course of the week. One of the most resilient going through this pullback. Technology, we did get stopped out of a couple of mid-cap technology companies. So our weighting is smaller there. And as you know, we've been underweight technology in general over the last few months. Energy is about the same, industrial slightly lower, real estate slightly higher. Materials about the same, and relatively small weights in communication services, utilities, and healthcare. These would be the more bond proxy sectors of the market. Last couple of things just to cover. We talked last week about the fact that while the Canadian dollar has been in an uptrend, certainly it was having a little bit of a pullback. We've been putting in a sort of a bottom. As of Friday, we were right in and around this trend line, bounced here today. So continues to look constructive in the long term. From a longer term perspective, Canadian dollar should trade along with energy and basic materials, which I think look constructive. From a cryptocurrency standpoint, again, Ethereum looks like it's continuing to consolidate, looks very attractive. Some might call this almost a cup and handle formation, looks quite interesting. And gold continues to consolidate. And while it certainly has been boring over the last few months, probably has some upside to it if it were able to get out of this consolidation. Look, we're headed into what is seasonally a pretty strong period of the year. Part of the money that goes into the market is individual investors, and they sometimes are more emotional. Some buyers are always there. We know that there have been a tremendous number of share buybacks announced over the course of this year. This will be the biggest year for share buybacks that we've seen in years. And they will continue on into the middle of the month and then begin again in January. We know that there are very significant new flows that come into the market at the beginning of the year. In fact, the money that comes into the market in the month of January is more than the sum total of all the money that comes in as a systematic approach for the rest of the year. So lots of flows to come in January, February, March, and April naturally. And so it may be that we're into sort of the Santa Claus rally. We'll see. If things were to turn down, if some of our sector work started to change, if our individual positions start to break down, we'll go to the sidelines. We're very happy to play defense. But the hardest thing in a bull market is to stay in your winning positions. The market will always try and shake you out. I think we have to keep in mind that the market is looking forward 8, 9, 10 months ahead. And if we're doing that, we're probably looking into late next summer and what may be happening in the economy by then. not what's happening just right now. So we continue to be constructive, and we look forward to hopefully celebrating a holiday season. And while we won't get to see a lot of you, we hope everybody has a good holiday. And with that, if Pam, if there's any questions, certainly happy to answer them.
Thanks so much, Dave. Yes, we have a couple of questions today. First one coming from Bob in Ontario. He wonders, he is an investor of Barometers and is wondering if we reinvested the sells resulting from the stop losses we took early enough to take advantage of today's markets.
Great. So as you can see, I'll see if I can jump back. We bumped up our financials. This is over the last week. So we bumped up our financials weight by almost 5%. We bumped up our real estate exposure. We also added a little bit more on the building product side, which I talked about being strong in the consumer discretionary areas. So yes, we did. We do have a little bit slightly more cash. If you look at our bond position, we do have to have some bonds in the balanced portfolio. You can see that it was slightly higher this week. So that would be very short-term bonds that were just being held sort of as cash. I think that money got deployed today. So we really got shaken out of very few positions going through the last couple of weeks.
Thanks so much, David. The next question, if the unprofitable speculative technology trade is falling out of favor in a reflationary environment, is that a potential concern for Bitcoin and Ethereum?
It's a good question. However, here's my take on Bitcoin and Ethereum. If you take the total investable universe for asset managers, pension funds, institutions, public market securities, fixed income, commodities, and so on, it's about $475 trillion. If you take the total value of cryptocurrencies today, it's about $3 trillion. So that equates to between 60 and 70 basis points, or less than 1% of the total investable universe. If you were to take most institutions, they are way below that in weight. So we think that 2022 is going to be a very important year for cryptocurrencies because they are not owned by institutions yet. In en masse, they almost own zero. So my guess is that as we come into the new year, investment policy committees will be making decisions to make initial investments. Now, this has been one of the few times that private investors are ahead of the institutional investor. You think about most cases, companies that are going public have had rounds and rounds and rounds of financing done in private rounds with large institutions before the public ever gets a shot at it. So from the first point is that it is so underowned as it stands today. It's not going to take a lot of demand to move prices higher.
That's a great point.
The second thing is that there are already many very profitable companies that have built applications on top of the blockchain. There are companies with $500–600 million in revenue already. So there are some quite profitable enterprises. And if you think about it with Ethereum, by buying Ethereum, you own a piece of the Ethereum blockchain platform. It's like owning a piece of the original internet. And there are thousands of companies building applications to create transactions using the Ethereum blockchain to verify the buyer and the seller. And every transaction that takes place burns some Ethereum as the fuel to make the transaction happen. So the Ethereum blockchain, I think, is growing at about 138%. The fastest year of growth in the internet was at 38%. The value of a platform is determined by the number of users of the platform times the number of users who are connected to other users on the platform, or the size of the web, times the growth rate. So I think we're still very, very early days on both Bitcoin and Ethereum. And certainly there are risks that other blockchain will come along and usurp some of the use, but I think we're a long way away from that.
Thanks so much, Dave. Those are great points. And I know that we were and have been early investors in that space. So appreciate your feedback on that. This is the final question for the day. We mentioned 2022, so we're going to go forward looking. David, this investor, David, wants to know what your favorite commodity for 2022 looks like and what your favorite stock would look like.
Well, look, I think the outlook for commodities is very strong. I think that the way to approach this right now, coming out of consolidation, is to have a basket approach. I think that you should anchor your holdings with some senior diversified companies like Teck Resources, like a Freeport McMoran. I think those are great anchors. I think that, you know, in energy, Canadian Natural Resources is a great holding, and I think that in forest products, a Canfor or an Interfor or something to take a look at. And then, but there will be big opportunities in mid-sized companies. And again, we would prefer to take a basket approach and have 3 or 4 or 5. And we are taking that approach. But you will likely see our weighting in this sector expand as we truly get these groups sort of re-breaking out. And it looks like we may be on the verge of that. So sort of stay tuned, because as that takes place, we'll probably put a little bit more of a spotlight on the group in these
Thanks
calls.
so much, Dave. Always very comprehensive, and I know our viewers appreciate it. On that note, let's wrap up, and I'll leave you with the final word.
Yeah, look, thanks everybody for tuning in. I hope these calls are useful. Sometimes there's a lot changing, sometimes there's not very much. And we're just trying to take a consistent approach to this. If you have any questions about your portfolio, certainly give us a call. If we're not working with you now, we'd love to, and please reach out to us. We'd be happy to have a conversation. It's going to be an interesting year. If we are in the early stages of reflation, which I truly believe that we are, there are years in front of us in expanding valuations in some of these groups. And some of them are really underowned and very small parts of the market. You know, when I think about energy, energy in the past has been as much as 30% of the S&P. It's about 4% of the S&P today. It's not because they just decided to take out a bunch of energy stocks out of the index. It's because we've been through a bear market in energy stocks. And so these groups can expand to be important parts of the market. Financials could certainly expand to be a much bigger part of the market. And there will be money to be made in the process. So we look forward to 2022, and thanks very much for having trust in us. And if you've got any questions, please reach out. Thanks very much, Pam, for hosting today.
Always a pleasure, David. Thank you.
See you all soon.